Active management of a treasury, in my mind, is figuring out how to generate yield and deploying that yield and reinvesting it to grow the treasury even more, right? You essentially want the yield that you're making to actually cover your outflows. That's when you've achieved the golden state of treasury management, is that you can continue to grow the assets in your treasury and pay for your expenses using the yield that you're making.
Bo Zhang began his career at JP Morgan, helping manage over 500 billion in client capital. He then joined FI Treasury, providing on-chain investment solutions for crypto treasuries. At Odos, he served as head of treasury and trading, optimizing DeFi order routing. And today he's the COO at Function, building institutional-grade infrastructure for Bitcoin DeFi. But what's the difference between loan-based market maker and retainer-based market maker, and which one do you recommend?
With the loan-based market maker, you're basically giving the market maker a loan of your tokens. The market maker sets certain strike levels and say, okay, if your token price trades above that, we get to keep a portion of your token, right? Retainer-based market maker is you give the market maker the cash to deploy on the exchanges themselves, and the market maker just makes sure that there's enough depth within certain spread levels, right? Really, which one is better? It depends. If you have the cash, go with the retainer-based market maker, right?
Welcome to the Accountant Quits podcast, where we help accounting and finance professionals learn how to manage a business using crypto. Bo Zhang is also one of the instructors in our upcoming course, the Crypto Treasury Management Academy, launching on October 29th, designed to help Web3 finance professionals learn how to optimize, allocate, and protect their organization's treasury. In this episode with Bo, we discuss risk management frameworks for DeFi treasuries, active versus passive yield management, how to work with market makers, derivatives and hedging, the rise of Bitcoin DeFi, and more. Why are Web3 organizations with massive treasuries not doing active treasury management?
So people are afraid to take action because they're not the subject matter experts, right? It's like asking someone to go drill for oil when they're a painter.
Bo, welcome, and thanks for making the time to be here.
Thanks for having me, Umar. Appreciate it.
I'd like to start with your background.
Sure.
So could you share with the listeners a little bit more about your experience transitioning from JP Morgan into Web3 a few years ago, and maybe what your role entail working at FIDE and Odos? Then we'll speak about Function a little bit later on.
Sounds good. Yeah. So I was on Wall Street for quite a few years, right? I spent a lot of time at JP Morgan. Most recently there, as you mentioned, I was a multi-asset portfolio manager in their chief investment office. I think across the desk, we ran $500 billion, and I traded equities, bonds, currencies, commodities. I was also focusing on crypto research for a bit when I was there as well. And at our JP Morgan private bank, we ended up launching it was one of the first private funds for Bitcoin, actually, that was offered to ultra high net worth clients on the street at the time. So back in 2021, I realized I started knowing more about cryptos than the actual stocks in my book. And I realized, you know what, it's probably time to pivot over. Because also I'd been following the crypto space since 2014, right? I've been like buying, researching, etc. And following the whole cycle, DeFi summer, right? 2017, 2018 bull run, and the subsequent crash. And at a certain point, 2021, my interest just laid a lot more in the crypto space, right, than they did in traditional finance. So I made a jump over. When I made the jump over, first started off with FIDE, which is a company that me and some mates started. We started off focusing actually on crypto treasury management, right? We wanted to create almost like an on-chain exchange fund for crypto assets. But we quickly realized actually that there wasn't a one-stop shop solution, right? And you can't take that approach for a crypto treasury. So we ended up pivoting into more very hands-on, in the weeds, working with individual crypto treasuries, as well as building simulations, right? Like agent-based simulations, on-chain simulations, stress tests, etc. So we did that for about 3 to 4 years. We worked with a lot of different treasuries. We worked with some of the largest protocols in the space. And then after a certain point, I wanted to dive more into a single project, right? Instead of what we were doing before, which is working with, call it one project for 3 months, 4 months, pivot, move on to the next, and rinse and repeat. I wanted to just stick with one project and work with them, right? And that was Odos, right? So I joined as their, call it, head of treasury and trading, help them set up the entire token management infrastructure, the DAO treasury infrastructure, right? How do we think about generating yield across the various assets that we have? Worked with them on market making, right? The whole 9 yards. And then, yeah. And then now the team at Function has asked me to join them as initially it was head of institutional strategy. Now it's going to be COO. So I'll be joining them as COO in the next week or two. And that'll be super exciting.
Okay, I'll change my role then when we market the podcast.
No worries. Titles are just in flux, man. This is crypto. Things are
I
always in
know.
flux.
Yeah. So, like I mentioned in the intro for the listeners, Bo is also one of the instructors for this new course that we're launching, the Crypto Treasury Management, launching on October 29th that will run for 4 weeks. So in this episode today, I actually want to touch on some of the topics Bo will be teaching, sort of a teaser to the actual course. And the first topic I want to touch on is crypto risk management frameworks. As at the time of this recording, the TVL in DeFi is approximately 146 billion. Now, investing in DeFi, of course, you'll have the usual credit and counterparty risk we see in TradFi, but arguably the biggest risk here is smart contract risk. In traditional finance, we do have rating agencies like Moody's or Standard & Poor's that assign risk scores, right? They provide this standardized framework. In DeFi, as far as I know, there's still not that real equivalent. So from your experience as head of investments at FIDE, where you had been stress testing different DeFi protocols, can you actually walk us through how that process looks like? And how do you assess whether like a DeFi protocol is high risk or low risk? What metrics or indicators matter here?
Yeah, no, that's a really good question, man. And I think as the ecosystem matures, right, we're going to see more and more of these type of risk stress testing methods pop up. I don't know if you saw this, but Sky Protocol, formerly known as MakerDAO, actually just got a credit rating, right, from S&P. They came out of B minus, right, but it was their first crypto project to have actually gotten a credit score, which is, I think, a fantastic move forward for the industry. There are certain credit rating systems, right, that folks use internally. So to your point, the only industry-wide one that I can think of is Credora. It's like a crowdsourced, right, credit rating method. A lot of funds have their own like internal rating mechanism, right? So like Galaxy Digital has their whole rating scheme that they published. RE7 has like a rating scheme as well. I think it's called the DeFi Risk Index. But most of these things aren't super public, right? And so for the general public, it's like, how do you actually evaluate the risk that you're taking on when you're deploying to your protocol? There are several layers here to really consider. First things first, right? And like this is kind of the stuff that we identified as well, is you go through the actual audits, right? Like obviously most people can't read smart contract code. I can't read smart contract code, but I can tell whether or not a project has been audited by a good audit company, right? And the extent of that audit. And so if you think of like the tier one auditors out there, right? Spearbit, guys like Zelig, Trilobit, right? If you see one of those audit companies on the project audit sheet, then all right, like chances are, right, they're a more serious project and they're happy to spend a lot of money on getting a good audit. So that's one prime example. Another one is if the project founders are actually doxxed, right? Like who are the people running the project? These are, I would say, kind of like the base level things that you can and should do. But I think as projects evolve in complexity, it actually becomes more important to conduct more thorough stress tests, right? So what we do, and this is obviously not everyone can do this, but what we do is we actually take a protocol and we will drop it, right? We will just copy paste the entire protocol and drop it at a historical point on the blockchain, right? Call it Ethereum network. And we'll create either a lot of different agents that have a common behavior to try to break that protocol, or B, we'll create a sandbox environment to see how the protocol would have behaved during those market conditions. Right. And to me, like that's the best way to actually stress test a project, right? Because then you can say, all right, I want to take Hyperliquid. Now I want to assume that everyone is going to go short this one token, or everyone is going to go long this one token. And I want to take into account how much money Hyperliquid is making, right? How many users are interacting with it, how many unique wallets, like the average size that the wallets are depositing into the protocol or are placing on a bet or a trade, and then just see what happens, right? Like you're literally testing the worst case scenario using live figures that the project has actually experienced, right? So to me, this is the like the truest and the best way to stress test a project.
And so for the listeners, the project that Bo mentioned earlier is called Credora. So Credora. You can check them out at credora.network. And I think you mentioned RE7 Capital as well has come up with their own like DeFi risk index.
That's right.
Now, I want to move on to another topic. And I should have mentioned this earlier, but nothing in this episode, of course, should be taken as investment advice. Now, over the past 4 years, you've worked with a range of Web3 companies, each holding different percentages of their treasury in fiat versus crypto.
Yep.
A lot of DAOs, for example, would hold 100% of their treasury in crypto. Now, many of our listeners, they're working on projects that hold large amounts of stable coins or native tokens like BTC, ETH, Sol. And from my conversations with those finance professionals, a lot of them are not really doing active treasury management. Now, a lot of these Web3 startups, they've got like small finance teams. Sometimes it's literally one person handling everything from operations, payroll, monthly reporting. And on top of that, they're now expected to also dive into DeFi protocols to look for yield. Based on your experience, how common is it for Web3 projects to have a dedicated treasury manager actually doing active treasury management?
Oh man, it's so rare. It's so rare. And there's so much money just left on the table because of it, right? If you're a startup and you got 4 million bucks in the treasury, right? You're newly funded, your burn rate's $1 million a year, right? For example, Bybit right now has a private wealth management program where you can earn 20 to 30% on stable coins at a 3-month lockup, and the max drawdown is like 1%. Now, obviously, everyone is a bit PTSD'd from FTX and stuff, but what we saw with Bybit earlier this year was like a proper stress test, of all of their systems when they got hacked, and they recovered like that. They just bounced back. And if you dig under the hood of some of these strategies, like these aren't a UST type of strategies where like it's created by some weird bonding system and then that when it depegs, it's over. This is actually just trading to capture market dislocations, right? So the things that a quant desk at a hedge fund or a quant desk at an asset management shop would do, these are the strategies that are being run by some of these exchanges, right, in order to deliver yield. And if you're a startup, for example, right, going back to 4 million, right, and then your annual burn is 1 million, put 2 million into something like that, making, call it 20%, right? That's 400K per year. All of a sudden, your runway extends from 4 years to 6 or 7 years, right? You're literally making 6 months worth of burn every year, right? So the fact that a lot of these resources go completely underutilized is mind-boggling to me. And same with assets on the balance sheet, right? Things like Solana, things like Ethereum, these assets should be staked, right? Same with Bitcoin as well, right? This should be put into some sort of yield generation mechanism, because the difference between an asset that's growing an extra 5% a year versus an asset that's not, right? After, again, going back to the 4 years example, you now have an extra 25% in value in that asset. And people just aren't capturing this. They're just letting it slip.
Why do you think that's the case, that these assets are remaining idle? I mean, those projects I spoke of, they can be like very large foundations with like massive treasuries. Uh,
Yeah.
because what does the role of active treasury management actually look like? I mean, do these people have to, I mean, staking, they can just stake it and that's it. They don't have to do anything.
Yeah. No, for sure. I mean, look, so to answer the first part of the question, right? I think there's the bias of if you don't do anything and like you miss out on gains, it's a lot better than you doing something and then it blowing up, right? So people are afraid to take action because they're not the subject matter experts, right? It's like asking someone to go drill for oil when they're a painter. They're gonna be like, wait a second, what am I doing here? I'm afraid I'm gonna hit like a land or like an electricity line or something like that, right? It's not one to one. But if you have somebody who actually has like a finance background or like a trading background or something like that, right, stepping in and observing the opportunities and then evaluating the risks and rewards, all these different opportunities, you can be a lot more effective with the capital that you have on hand. So I think that's why a lot of these projects aren't doing too much stuff with it, right? They're not subject matter experts or they don't have one in place and they're afraid that, if it blows up, right, then obviously that's game over and their fault. But if you know what you're doing, like it's not going to blow up. Like if you put it into very safe strategies or just like Ethereum staking, odds are most likely 99.9% it's not going to blow up. Now, the second part of your question was like, what does active management of a treasury actually look like, right? Active management of a treasury, in my mind, right, when it comes to the actual asset allocation component of it, is figure out how to generate yield and deploying that yield and reinvesting it to grow the treasury even more. Because the ultimate end goal that you want to achieve if you're running a treasury is call it liability management, right? ALM, right? You essentially want the yield that you're making to match the duration of your outflows and to actually cover your outflows. That's when you've achieved the golden state of treasury management, is that you can continue to grow the assets in your treasury and pay for your expenses using the yield that you're making. Some projects like Mantle, for example, they make like 30, 40 million bucks a year from their treasury. Granted, they have one of the largest treasuries in the space, but still, it goes to show what you can generate if you actually put the assets to work versus just letting it sit idle. But yeah, that's the what I think an actively managed treasury should look like.
Before we continue, let's take a quick commercial break from our sponsor. If you're serious about running your business using crypto, you need tools built for crypto. One of my favorite apps, and yes, one that I use multiple times a month, is Request Finance. This app has been a game changer in how I invoice my clients and receive stable coins and crypto directly in my wallet. But hey, there's so much more to it. Request Finance is the all-in-one platform for crypto operations, accounts payable, accounts receivable, expenses, and even accounting. Plus, they've got a killer multi-pay off-ramp to over 190 countries, meaning you can pay someone with crypto and they get fiat in their bank account. Request Finance connects to over 20 blockchain networks, including Ethereum, Solana, Base, Arbitrum, Near, and more. Here are some features that I love. Batch payments using your preferred wallet of choice, a single dashboard to track all invoices with real-time updates. All invoices contain the transaction hash for easy audits. But hey, don't take my word for it. Try it out for yourself. Head over to requestfinance/partners/theaccountantquits and get 2 months for free with all the pro account features. Join 3,000 finance leaders today using Request Finance and make crypto operations simpler, compliant, and less stressful. Perfect. Now, one of the modules of the course is on native token management, where you'll be exploring working with market makers, OTC desks, custodians. For our conversation today, I'd like to focus on market makers only. For Web3 projects with a native token, how should they approach working with a market maker? And also, could you please explain the difference between what loan-based versus retainer-based agreements actually look like, and which model, maybe in your experience, tends to work best?
Yeah, for sure. I mean, so, if you have a native token treasury, you basically are just trying to, one, get yield on that token, or two, like just actually manage that token, provide liquidity, allow people to buy, sell, etc. I've seen a lot of projects where tokens just have zero liquidity, right? Or the flip side, they have too much liquidity, right? And they can't actually allow price discovery. Now, both sides are quite painful. Obviously, one is more painful than the other. But working with the market maker means that you have just the right amount of liquidity, and your market makers should be advising you on this, right? If they're not, then they're shit market makers, right? They should be telling you when you have too much liquidity. They should be telling you when you need to top up, across what exchanges you need to top up on, right? What you need to do to hit your milestones, your benchmarks, new exchange unlocks, etc. Market makers should be, in addition to just market makers, right? Like advisors and guiding you through the process. Right. Oftentimes, what I see is, especially with the large market makers, they have a lot of clients, right? They have a lot of projects that they work with, and even though they might have a team like 10 people in the group chat, nobody responds. Right. They're not who you go to for advice. All they'll do is just trade your token or provide liquidity on your token, and then some do it poorly at that. So the difference between a loan-based and a retainer-based market maker, this ties in, is with the loan-based market maker, you're basically giving the market maker a loan of your tokens. The market maker sets certain call levels or strike levels and say, okay, if your token price trades above that, we get to keep a portion of your token, right? Retainer-based market maker is you're working with the market maker. You give the market maker the cash to deploy on the exchanges themselves, and the market maker just makes sure that there's enough depth within certain spread levels, right? Call it plus or minus, plus 2%, etc. Really, which one is better? It depends. If you have the cash, go with the retainer-based market maker, right? I would never, never encourage someone to go with the loan-based market maker if they have the cash. Why? Because going with a loan-based market maker is inherently bad for your token price. And because every loan-based market maker, depending on how you price or who they are, will either pull liquidity or sell into a token downturn to recoup losses. Right. So that's the whole market making setup there. With a retainer-based market maker, you are the master and commander of the liquidity on your books. You can decide how much to add, how much to pull. You can decide just exactly when is the right amount, right? And you don't have to worry about any negative price impacts to your token. So if you can afford it, and by afford I mean afford to post liquidity on the exchange, go with a retainer-based market maker. I would never encourage anyone to go with a loan-based market maker.
Perfect. Now, one of the other area that you specialize in is in crypto hedging. And it's actually the first time I'm covering this topic on the podcast. It actually took 99 episodes to get here. So to start, could you give a short overview of the differences between options, futures, perpetuals, and delta neutral positions? I just want to maybe help the listener not having to pause what they're listening and maybe go on ChatGPT and ask this.
Yeah, sure. So let's break it down into two different types, right? They're all derivatives at the end of the day, but you got options and then you got futures, right? Everything else is just, what you can do with it. So options are basically you have the option to buy or sell at a pre-agreed upon price in the future, right? You don't have to, but you can. A future is basically you are committed to that, right? You have to take that position. In terms of something like a perpetual future, right? Versus a standard CME Chicago Mercantile Exchange type of future is basically the settlement, right? Whereas with a CME type of future, you have rolling settlement, you have periodic settlement that are bound to specific durations. Perpetual futures are just always rolling, right? They're perpetual, right? They have 8-hour funding rate periods where, every 8 hours, one side pays the other depending on where markets are moving. And it was actually, I think it was created by Arthur Hayes, right? The perpetual future for cryptos. And it's been adopted by just about every single exchange. It's like a perpexes, right? That's what they are. This is one of the major financial innovations that the crypto space has actually brought. And I think that the traditional finance space could actually learn a lot from. That said, the idea of perpetual futures isn't new. I think the original call it traditional finance white paper for it came out back in the 80s or 90s. But then it just was never really explored until cryptos came about. And then I think Arthur Hayes, like launched the first set of perpetual futures, right? So those are the two different types of futures contracts, CME, standard futures, right? Like traditional finance futures versus perpetual futures. Now, what a delta neutral position is, it's quite literally just being long on a spot position, short on a futures position at the same time. You're essentially hedging out the price risk that you're taking on, and you're just clipping the basis in between the spot and the futures position. If you do it with CME, the CME futures and the spot price will converge, right? So you know exactly what you're locking in. With perp markets, for example, right, you're clipping the funding rate, right, in between perp and spot. And so right now, or rather over the last, call it, year or two, perp markets have been a lot more lucrative than the traditional market because all the large players, traditional players, go to CME, right? Whereas smaller players and the non-traditional players still do the funding rate arb in crypto. Yields right now vary. Let's say on Bitcoin, you can get plus or minus 10%, right? But it's fluctuated dramatically. Like some months it's zero, some months it's negative. It can turn negative really quickly. So you need a really good, call it, options management system, right? To be able to actually do this trade yourself. Most likely, if you're running a treasury, you should just outsource it.
That's interesting. So using derivatives, it requires specialized knowledge, and you said it right that you should outsource this.
100%, right? Like if you're, let's say you're like managing this trade yourself, right? You're long the spot, you're short the futures, right? All of a sudden prices move against you, right? You have to rebalance your short position in order to stay short. Otherwise, you're actually taking a market risk, right? And then you have to manage your liquidation levels so you don't get blown out of the books, like what happened this past weekend, right? And even if you do all that correctly, you still have to make sure that the exchange doesn't just cancel your position like Hyperliquid did, right? To like all of the positions that they had, which anyway. But it takes layers of risk management and constant monitoring in order to not lose your shirt in this game, right? And so if you're just a one-man team or a two-man team or even a three-man team, like there's no point in running those yourself. Outsource it to a fund where this is all they do and has like a 10-person team running this, building out their own risk management trading infrastructure. What your job is then, as called like the CFO, is to conduct due diligence on the traders that you're giving the capital to run the strategy, right? Or the fund that you're giving this to make sure that the fund is legit. That's your job. Your job shouldn't be to run a strategy in-house yourself.
Right. So in crypto right now, at least perpetual futures make up the majority of derivatives trading. Of course, Hyperliquid is currently leading the market. I was looking at some of the figures while preparing this episode, like the trading volumes have exploded now over like 1 trillion every month, according to DeFi Llama. So you've said it right, Web3 organizations need to outsource this. Have you seen in practice that some of the Web3 organizations are actually outsourcing this function and actually
Sure.
utilizing some sort of like hedging mechanism?
For sure, yeah, absolutely. Protocol treasuries, for example, outsource this to on-chain funds, right? A decent amount. I think they should do it more, to be honest. Like Edge Capital, for example, right, runs the treasuries of some of the large foundations, and they deploy systematic delta neutral strategies in order to do so. RE7 as well, right? They run like these systematic delta neutral books. Like most of the on-chain fund managers and just about all the crypto hedge funds have this as one sleeve of their strategy, right? It's the easiest thing to do in terms of a systematic strategy. As far as systematic strategies go, that's why everyone runs it, and it's a very efficient use of capital. But you do need like a team to manage it and stay on top of it. Like otherwise, you as a one-man person can't be monitoring a position 24/7.
Now, over the past 2 years, we've seen the shift in what people are referring to as Bitcoin DeFi. We're moving from a mindset of just BTC accumulation to now Bitcoin deployment where the smart treasuries are actually starting to put their Bitcoin to work. New protocols like Babylon, Lombard Finance, and Function, the project you're currently working as their COO, are all working to unlock Bitcoin liquidity and bring it into DeFi. Everyone is taking like a slightly different approach. We'll dive into function in the next question, but to start, can you walk us through the current state of Bitcoin DeFi and share what personally excites you about joining function at this stage of the ecosystem?
For sure. I mean, I think BTC DeFi is there are pros and cons to it, right? Obviously, we had the whole BTC DeFi kind of wave last year, which I would say for the most part just fizzled out, right? People realized that there wasn't really any like real yield that was being delivered by a lot of these projects. And of course, like layer two development on BTC has kind of stalled, right? I have my own reasons for why I think that is, but overall, like if you think of BTC and what the future of it looks like, it's never going to be used as like a payment asset, right? What it will be, it's a store of value, right? Part of that is because if you are super rich and a BTC whale, you got here by not messing with your Bitcoin, right? You just kept it there as a store of value. And it was indeed a store of value, and you've done very well. And so that type of positive reinforcement loop is incredibly difficult to break, right? So I think moving forward, BTC will always be viewed as a store of value. But that said, the returns and the volatility for Bitcoin has compressed dramatically, right? Previously, you had annualized volatility for Bitcoin being 500%, then down to 300%, then down to 100%, then down to 50%. And so moving forward, the upside that you're going to get from Bitcoin is going to shrink a lot. But still, that said, it is the number one crypto asset, crypto token. And if Bitcoin goes, everything else goes, right? So if you have this massive asset that's a store of value and you see returns compressing, then the smart thing to do is to generate yield on top of that store of value asset. So now not only are you capturing the actual price return, but you're then capturing additional yield on top. And so if you look at, call it S&P 500, right? S&P 500 on average annualized returns is around 7%, volatility of around 16%, right? S&P 500 has yield. Most people don't know this, right? Or they don't realize it. But stocks pay out a dividend. S&P 500 stocks, generally speaking, all pay out a dividend. And the average yield for S&P 500 is around called plus or minus of 1.5%, right? So now at 1.5%, you're now making 8.5% a year on S&P 500 at the same volatility instead of 7%. Over the course of 5 years, that extra 1.5% compounds to call it 9, 10%, right? So for every 5 years that you're deployed in, you get an extra year out of it, right? At least, right? So on Bitcoin, you can almost think of it as something similar, right? Like assume that the price of Bitcoin is only going to increase at 50% a year moving forward on average. Still quite good, very good. But it's a lot lower than what it was before. Now, imagine if you can make an extra 5% on top of that, right? Now, after call it 5 years, compound that, you've got an extra 35% plus or minus, right, of your returns relative to somebody who wasn't invested. And if you expand out over the course of 10 years, right, if you think about just holding BTC as a stable part of your portfolio moving forward, that's 100% delta, right? Now, all of a sudden, right, instead of returning, call it whatever, 300-400%, you're now returning 400-500%. That's the difference between $3 million and $4 to $5 million, right? It's a decent chunk of change. So I think as volatility for the asset class compresses, the hunt for yield is going to become ever more important. And with function, we're here to essentially deliver that yield, right? In a completely transparent, non-black box way. And when people say the age of BTC DeFi has kind of died or never really materialized, I think it's because people just didn't see the yields they wanted to see, right? People didn't see the development and build out that they wanted to see. There wasn't a massive rush to deploy BTC into BTC DeFi. Part of that is quite literally just because, right? Like, how BTC whales kind of got to be BTC whales is they just didn't mess with their stack. But the other part of it is because a lot of the tech was stuff that people just didn't understand. A lot of trading strategies was very black box, right? If you look at some of our competitors or funds out there, they're running these strategies and people have no idea what they're actually running. You can't see where your assets are. You have no idea where your assets are going. You don't know, like, you're basically trusting the fund manager completely. Whereas with Function, we can generate 4, 5, 6, 7% yield on Bitcoin, right? And everything is on chain. Everything is transparent. You know exactly where your assets are going. There's no complex, crazy DeFi looping, right? There's no crazy triple lever or quadruple lever like plays, all right? It's very straightforward, very simple DeFi strategies that we work with our curated partners to deliver to investors. And so I think that's what gets me really excited about the company, right? Is the fact that this is solving one of the largest problems in the space, which is how do you actually get meaningful BTC yield in a transparent way, right? And I think that unlocks the next wave of BTC capital moving into the space.
Can you walk us through, let's say there's a Bitcoin holder listening and they actually want to use Function. Could you provide us with like a walkthrough? Like they'll have to probably go on Function's platform to the app
Sure.
page and probably wrap it into FBTC, right?
That's right. So right now, as the project is in its infancy, we're building out a lot of the on-ramps onto FBTC. Right now, as a retail user, you can get FBTC by either buying it through Uniswap or going to Bybit and minting FBTC for your BTC, right? A Bybit Earn also has yield on BTC that's completely run by FBTC, right? So we are the entirety of the Bybit on-chain BTC Earn platform. If you're like a large whale, right, things like that, we will actually work with you on a very hands-on, like white gloved experience to onboard you onto the FBTC platform and ecosystem. We help you mint FBTC. We share with you the curated strategies that you can deploy FBTC into. Right now, not everyone can access the same strategies because there is a size requirement. You need to pass like a high net worth checklist, right? Same thing with Midas, exact same principle. But we will work with you on a one-on-one basis, KYC, etc., and then onboard you onto the platform and then help you deploy it into the strategies, right? The same way that many of these, I would say, more legitimate and institutionally focused yield platforms are operating under.
So this reminds me of a previous protocol called Ren Protocol, right? Where you could also wrap your Bitcoin into, I think it was called Ren BTC. So it was, yeah, the wrap version of Bitcoin where you could then deploy it into DeFi. But if I'm not mistaken, Ren infrastructure, it was shut down after Alameda Research collapsed in late 2022 with FTX fallout. What can we learn from that whole experience of what happened with Ren?
I think that's a great question to ask, right? And I think that actually is what makes FBTC and Function super unique. The history behind FBTC was that it was actually created by the largest miners in the space, right? Along with some of the largest publicly listed companies in the space, because they didn't trust WBTC, which was the Sun. They didn't want to just fully rely on Coinbase with CBBTC and the US regulatory system. They wanted a type of on-chain BTC, ERC20, that met their incredibly stringent security requirements and that wasn't bound to a single geography, that wasn't tied to a single entity, right? And so FBTC was born. Now, from a from a technological perspective, right, the underlying FBTC isn't that innovative, right? It's pretty much the same code base or code stack as like a CBBTC or a WBTC. But the thing about technology, right, it's not how complex or convoluted or high tech something is, it's what you can actually do with the tech. You can build the most powerful infrastructure in the world, but it doesn't matter if no one's ever going to use it, right? Because they couldn't understand it. With FBTC, what's really interesting is that one, it's fully ERC20, fully transparent, backed by proof of reserves. You can see everything on chain. You know exactly where all the assets are held in the background. We're split up across a variety of different regions, right, and different chains. But two, and I think this is the super important part, the underlying BTC that we hold does not move. It's always sat there in the custodian. We're not like some wrap BTC protocols will take that BTC. I'm not gonna name names, but they'll take that BTC out of the custodian. They'll give it to a trader or a fund, right? Who will then trade on it, and then all of a sudden you're exposing yourself to counterparty risk on the trader side. You're exposing yourself to exchange risk. All this. No, with FBTC, all the underlying assets are literally just sat there in a custodian, the safest place possible, right? Short of you building like a nuclear bunker and then putting your right like ledger in there, but it's all just sat there, right? FBTC is just minted on top, and that's the asset that moves around the ecosystem. So incredibly secure underlying stack and how we handle the underlying BTC relative to others. And third, and also quite important, is this security council of FBTC, where instead of relying on a single entity or a single person, right, to decide the fate of the entire network, or in this case, asset, our security council is comprised of four of the largest, and many of which are publicly traded players in crypto. So the security council is Alpha, who's the essentially loan book or the asset management arm of Bitmain, right? Or the lending arm of Bitmain, I should say. Again, publicly traded company, one of the largest BTC players in the world, right? Period. Galaxy Digital, right? Everyone knows who Galaxy Digital is. Mantle, who's top 20 project in the world, the largest treasury in the world, period. And Kobo, right? A custodian. So the way that we've split up our security council even is geographically diverse. It's not tied to a single person. It's not tied to a single entity. And it's all institutionally driven. The idea behind FBTC is that this is an asset with a security stack, right? That is made by institutions for other institutions who have the same type of security requirements that the initial creators of FBTC did, right? Which is, in essence, incredibly stringent.
Great. That was a very good clarification. Now, during Token 2049 Singapore a few weeks ago, you spoke about Function's broader vision, building a network of functional assets and collaborating with some of the projects that you mentioned earlier, Mantle, Bybit. There's a new project called UR Bank, which I haven't heard before. Now, for the listeners who might have missed that talk, could you share that vision? What exactly does a network of functional assets mean? And yeah, maybe also share some of the other partners or ecosystems Function is currently looking to work with.
Got it. Yeah, for sure, man. I mean, look, I think we've seen the rise of RWAs in the last year, in the last 2 years. I think a lot of people understand the term RWAs. I think a lot of us don't understand what our RWAs are actually going to entail, right? Again, it goes back to don't sell the tech, sell what you can do with the tech. What can you do with RWAs right now? Most of them don't have liquidity. Most of them are just kind of sat on chain. They're just a tokenized version of a fund. People are using it for basically tax avoidance, right? Because they don't want to move their assets off chain. And that's the main source of inflow for RWAs at the moment. For us, we think there should be additional use cases to these RWAs, whether that's borrow lending markets, whether that's call it predictions on yield, right? Whether that's deployment across the broader DeFi ecosystem for incentives. Yeah. There needs to be another functional layer to these RWAs rather than just you putting money into it and it just sat there, right? Because I can do the same thing with my brokerage account today. And I would actually prefer to do that because those are rails I trust and I understand. So unless there's some sort of reason, a use case that people can get out of RWAs that they can't get out of traditional assets off chain, they're never going to move into RWAs, right? And tax avoidance as a use case can only last for so long, right? So for us, our goal is working with Mantle, the broader ecosystem, working with other chains as well. We're just actually integrated on Plume as of today. We want to build these functional use cases for RWAs, build a functional marketplace where people can take the RWA and work with us to get even more yield out of it, right? I'm not talking about, again, triple, quadruple levered, crazy DeFi looping nonsense. I'm talking about very simple strategies and very simple markets where you can deploy the build fund into, right, for additional incentives or for additional yield. And that is what we're hoping to accomplish working with the partners that we have today. FBTC, and as an asset, is just a blueprint. It was a proof of concept in our minds that we were able to tokenize an entire asset stack and build a market around it, a marketplace around it for yield, where there wasn't one before. Moving forward, we plan on doing the same thing with the rest of the RWA token stack.
Perfect. As we wrap up our conversation today, Bo, I want to take a step back and look at the bigger picture. If you think about treasury management in Web3 with everything from on-chain risk that we covered earlier, cross-chain liquidity, DeFi positions, to stablecoin allocation, it's still a relatively young discipline, right? So
Yeah.
maybe as closing thoughts for today, from your perspective, what should be the North Star for Web3 projects when it comes to treasury management? Maybe if you could share a few guiding principles like founders and CFOs can keep in mind as they are building their treasury department to be more resilient, more transparent.
For sure. I think the main question that folks need to ask themselves, right, founders, is what do they hope to get out of the treasury, right? Do they want to grow it? Do they want to sustain it over time? Are they just worried about drawdown and they're just happy using the assets as assets? What do they want out of their token, right? Is it just a community thing? Do they want to generate some yield or make returns on their token as well? These are the fundamental questions that and the starting point that they need to have before they can dive into any of the rest of this. Once they have asked themselves that question and understand what they want to get out of it, then they can structure the team and the actual functionality around it. In my opinion, the use case of a treasury is to continue to grow and sustain the protocol and the development into perpetuity, being the operative part of the sentence here. And the best way to do that is to follow some sort of like an asset liability management scheme, right? Is to allow yourself or enable yield generation, enable ways to use your treasury to make money that then covers the outflows that you actually have to pay. That to me is the holy grail of treasury management and what every company should be aiming for with their treasury. The question is, based on your starting point, how do you get there? And that's what we're going to cover in the class.
Exactly. Perfect way to end the episode. Yeah, I think we gave the listeners a small taste of what's coming today. And it was great to talk today, Bo. So I usually like to end the podcast with asking the guest if they have a favorite quote or maybe a maxim that they live by or they often repeat to themselves.
But I have a few, but one of my favorite ones was from the Iron General, right? I don't know if it's kosher to say or to reference him, but it's the wise man learns from the mistakes of others, right? Where others have failed on their treasury, don't let that be you, and learn from the mistakes that have been made in the many years of crypto blowups that have happened so far. Right? Yeah, I think that's pretty apropos.
Yeah, it is. If people want to learn more about Function, where should they go? And if people want to reach out to you, Bo, how should they do so?
Sure. So for Function, definitely hit up the website www.fxn.xyz. We have an email at the bottom where you can send an email and it goes out to the entire team. So if you want to get in touch with anyone on the team, that would be the best way to do so. And then if you want to reach out to me personally, my Telegram is always open. I am at BOZHANGLES.
Great. I'll be sharing that in the show notes of the podcast as well.
Awesome.
Cool. So see you very soon when we start the treasury management course on the 29th October. If anyone listening is actually interested to learn more about this course, you can go to theaccountantquiz.com/treasury management academy, or you can just reach out to me on LinkedIn or Twitter. Until then, see you very soon.